heck is going on down here? I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
It's May 6th, 2010. Wall Street is buzzing like any other day. Traders are glued to their screens, hedge funds are making moves, and algorithms are doing what they do best, trading at lightning speed. Then, out of nowhere, chaos erupts. The Dow Jones Industrial Average suddenly drops nearly 1,000 points in just a few minutes. That's almost $1 trillion erased from the value of US companies in just 5 minutes. Stocks of major companies like Procter & Gamble drop by nearly 40%, and some stocks are being traded for literal pennies. Investors are in shock. News anchors scramble to make sense of what's happening. Is this another 2008-style crash? A cyber attack? A market-wide glitch? Then, just as quickly as it started, the market bounces back. Prices recover. The panic fades, but no one knew what the hell just happened. At first, experts blamed a simple mistake, a fat finger trade, where someone accidentally placed a massive sell order. But as regulators dug deeper, they uncovered something far more shocking. This wasn't just a glitch. This wasn't just a random crash. This disaster was triggered by a single retail trader, Navinder Sarao. Operating from his parents' home in London, in the midst of the chaos, he quietly made $40 million. Yet, it took authorities 5 years to track him down, the mastermind behind the 2010 flash crash. But how could one trader, alone in his bedroom, shake the entire US stock market? To understand this, we need to dive into the world of high-frequency trading, market manipulation, and one of the most bizarre financial scandals in history. And you're watching The Money Game. Before we dive into Navinder Sarao's role, let's break down the events of May 6, 2010. The market was already on edge, with the European debt crisis looming. At 2:32 p.m., the Dow plunged 600 points in 5 minutes, and stocks like Procter & Gamble dropped by as much as 37%. Major companies were being traded for pennies. The sell-off intensified as automated trading systems kicked in. Then, as quickly as it had fallen, the market rebounded by 3 p.m. The crisis lasted only 36 minutes, but in that short time, billions of dollars were lost and regained. Initially, the blame fell on a mutual fund that had placed a massive sell order on E-mini S and P500 futures. But further investigations uncovered a more shocking truth. A retail trader, Navinder Sarao, had played a key role in the chaos. Navinder Singh Sarao was no Wall Street tycoon. He wasn't a hedge fund manager or a billionaire investor. He was a relatively unknown trader working from his parents' home in Hounslow, a suburb of London. He built his empire sitting in a small room filled with computer screens, while most of us were probably binge-watching Netflix. So, who was he? Nav wasn't your average financial professional. He studied computer science and finance, which gave him the tools to understand and navigate the market, but what set him apart was his hatred for high-frequency traders, HFTs. These big players used algorithms and speed to dominate the markets, and Nav felt like they were rigging the system, leaving everyone else in the dust. So, he decided to beat them at their own game. Unlike big trading firms with armies of analysts, Nav operated alone. He used a modified version of the trading software TT-X-Trader, which allowed him to execute orders at lightning speed. He mastered a controversial tactic called spoofing. This wasn't just trading, it was market manipulation at its finest, or worst, depending on how you look at it. To understand how Nav shook up global markets, we need to dive into the world of high-frequency trading, HFT, the very thing he despised. So, what exactly is high-frequency trading? It's like the financial markets on steroids. Instead of humans making decisions, HFT relies on algorithms and ultra-fast computers to execute trades in milliseconds. These algorithms capitalize on tiny price changes by buying just a fraction of a second ahead of others and reselling for small, rapid profits. Over time, those tiny gains add up to millions. Think of it like skimming. Traders use speed to grab profits before anyone else can react. And to stay ahead, these big firms use fiber optic cables, collocated servers near stock exchanges, and algorithms so fast they operate at speeds humans can't even comprehend. Sounds efficient, right? But there's a downside. These systems are so quick to react that they can cause wild market swings. Imagine a herd of animals stampeding at the slightest sign of danger. That's how HFT algorithms behave. When one moves, they all follow. And when chaos hits, the results can be catastrophic, like in the 2010 flash crash, when the Dow Jones dropped nearly 1,000 points in minutes before bouncing back. For Nav, this wasn't just about market fairness, it was personal. These automated systems were eating into his profits, making it harder for him to make money as an independent trader. But instead of giving up, he fought back, using their own speed and algorithms against them. Here's where Nav's spoofing strategy comes in. While the big HFT firms were making money by reacting to market movements in milliseconds, he decided to mess with their algorithms using spoofing. How did it work? Fake orders. Nav would flood the market with massive fake sell orders on E-mini-S and P500 futures contracts, a key market indicator. To the high-frequency trading algorithms, it looked like a huge wave of selling was about to hit the market. Market reaction. These algorithms, designed to react instantly to market signals, would start selling too, thinking prices were about to drop. Quick cancellation. But here's the trick. Before those fake sell orders could be executed, Nav would cancel them. Meanwhile, he'd already bought at the lower prices caused by the panic selling. Profit. As the market stabilized and prices bounced back, Nav would sell what he bought, raking in profits. Nav was essentially playing a game of chess with the market, but he was both the strategist and the opponent. His fake orders manipulated the behavior of HFT algorithms, giving him an edge they couldn't outthink. And he didn't do this once or twice. He did it over and over again, making $70 million between 2009 and 2014. On May 6, 2010, everything came to a head. Nav's spoofing coincided with an already unstable market. His fake sell orders created a domino effect, triggering a wave of automated selling by HFT firms. The result? A market meltdown. The Dow Jones plunged nearly 1,000 points in minutes, marking the largest sudden drop in history, only for the markets to rebound just as quickly. It was pure chaos. Regulators and exchange officials scrambled to figure out what had just happened. Meetings were held with executives from the New York Stock Exchange and Nasdaq to investigate whether differing exchange rules had contributed to the crash. Over the next few months, regulators launched a comprehensive investigation to uncover the mystery. Who was behind the chaos? What triggered such a monumental crash? Despite their efforts, they struggled to understand the role of HFT manipulation. In fact, the SEC's initial report placed the blame on a mutual fund, claiming it had inadvertently caused the crash through large sell orders. And Nav? He wasn't even on their radar. Months passed and US regulators finally released a detailed report. It explained what happened during the flash crash, but didn't mention spoofing or anything about a rogue trader. Unaware of the growing scrutiny into the world of trading, Nav continued to operate successfully in the years following the flash crash, but his luck was about to run out. By 2014, patterns in the data began to raise suspicions. A whistleblower, analyzing market activity, noticed something peculiar. Massive orders appeared and disappeared almost instantly, a hallmark of spoofing. This was no ordinary trading pattern, it was a red flag. Regulators and exchanges finally began to connect the dots. The same trader's orders kept disrupting the markets, and his tactic of frequently canceling orders was too blatant to ignore. Nav's trail of manipulation was finally catching up with him. In 2015, the CFTC, Commodity Futures Trading Commission, launched an investigation and traced the suspicious trades back to Nav. That same year, he was arrested in London and faced extradition to the US. The charges were serious, 22 criminal counts, which could have added up to 380 years in prison. His bail was set at £5 million. With the millions he'd made, you'd think he'd have no problem paying it. But here's the twist. Nav couldn't come up with the money. It turned out that much of his wealth had been scammed away by shady investment advisors. They'd promised him risk-free returns, but instead, they siphoned off almost $50 million of his fortune. Despite being a brilliant trader, Nav's financial naivety was shocking. He'd trusted the wrong people. Eventually, his bail was reduced, and his parents put up their home to secure his release. As the extradition process moved forward, Nav's lawyers negotiated for leniency. They argued that he wasn't a cold-blooded criminal. He was a man with Asperger's syndrome, someone who lived a simple life and had been swept up in the thrill of trading. The US authorities, acknowledging his cooperation in helping them understand financial crimes, recommended a lighter sentence. And the judge agreed. Nav was sentenced to just 1 year of house arrest. Despite earning $70 million during his career, Nav ended up penniless. When he was arrested, he had just $1,000 in his bank account. For Nav, the money had never really mattered. In 2016, after years of legal battles, Nav pleaded guilty. But his story didn't end there. He worked with authorities to help uncover and catch other financial criminals. His cooperation, along with his autism diagnosis, played a significant role in reducing his sentence. Nav wasn't your typical financial villain. He didn't run a Ponzi scheme, steal from investors, or live a lavish life. He was a lone trader who outsmarted an already flawed system, until it all caught up with him. His story is as shocking as it is revealing. It exposes how fragile financial markets are, how technology has reshaped trading, and how regulators still struggle to keep up with those who can game the system. So, the next time the stock market takes a wild turn, remember, it might not be a global crisis. It could just be someone, somewhere, sitting at a computer, outsmarting the entire system. Money never sleeps on Wall Street, and neither does on our channel. Watch all the mind-blowing Wall Street stories and intriguing money movies all here in one place. Like this video and subscribe to The Money Game to level up your financial game today.